Hey, everybody, welcome back to the Mustard Seed Bitcoin podcast. This week I have on Brian Brookshire. Brian, welcome.
Thanks for having me on. It's great to be back on with you and do a part two, as it were. It's the first podcast we did a little over a year ago now.
Yeah, absolutely. I think we recorded that last podcast in I think it was July of 2024. I was obviously working at Unchained at the time, a prominent Bitcoin only company, and it was. I feel like when we went through the work that you had done, you kind of had gone back and analyzed what strategy, or I guess back then it was probably MicroStrategy, like what they were even doing and what their balance sheet actually looks like. Uh, could you imagine of like where this entire space has evolved to since we recorded that, I guess, a year and a half ago?
Yeah, there's definitely been a lot of changes. I think, at the time I put that together, people still really didn't understand how convertible bonds worked, how the premiums stacked together to make those accretive. People didn't even understand Bitcoin per share at the time. I think just, the broad understanding of the marketplace has dramatically increased. Of course, we've moved on to different products. Strategy has their preferred stocks out now. And there are an order of magnitude more companies trying to replicate the strategy. So I think it's blown up, I think, far more than many thought. The time we recorded, that was before the big November run up last year even. So um, yeah, it's been quite a year. It's been tremendous growth in the space.
Yeah, it's been pretty awesome. And I mean, like, I guess by that point, summer of 2024, I mean it, even by 2021, I would have argued that MicroStrategy was a huge success. But it really wasn't until after that, like you mentioned, like we got that huge, I guess, post-Trump election blow off top that occurred at the end of 2024, and that's kind of in my mind like what kicked off the entire Bitcoin corporate treasury like wave after strategy. I guess you had like Similar Scientific started in 2024, I guess before we recorded that podcast. Metaplanet, I guess, had started as well. But then really the blow off top at the end of 2024, I feel like was kind of the catalyst to like really accelerate the entire space. Would you agree with that, or do you think it was brewing at a different time?
Yeah, I think that's right because I was covering both those companies, Semler and Metaplanet, at the time, and there was no interest. Metaplanet had done a 5x, and I was posting, "Wow, this is awesome! Metaplanet did a 5x." That post got 0 likes, zero. And it wasn't until a year later where people were like, "Oh yeah, there might be something interesting going on here." And I think it really was that November blow off top where everybody suddenly was interested in strategy. Then a few months later was when the majority of the companies came out. Um, the vast majority of the new companies launched in April or May of this year, or some in March. But I think if we had not seen that rally at that time, I don't think we would have seen the explosion of companies that we did. Because just a year and a half ago, the conversation was still very much why aren't more companies doing this?
Yeah.
And now it's like, wow, there's so many companies out there that now we're looking for consolidation and M&A, and so it's a completely different picture to a year and a half ago.
Yeah, it is pretty crazy how like we waited so long and we were like, why are more companies not copying it? And then finally, companies actually started copying the strategy. And I feel like I'm curious if you agree with this as well. It's like prices and markets are like signals for market participants to do something or start paying attention. I mean, I think back to all of the historical Bitcoin bull markets where a lot of people don't really learn about Bitcoin until the price is going up. And then they then figure out that it's a better form of money. They might happen to buy the top, and they learn the hard way that it's long-term savings technology, not short-term savings technology. But to me, like price is a huge signal for Bitcoin and even money itself. Do you think that the MicroStrategy blow off top in 2024, that was like the market signal for all of these treasury companies to come to light? Like it was literally just the market saying, hey, I want more of this amplified Bitcoin exposure. And then that led to a bunch of entrepreneurs, and even you yourself. I know you joined, you were at H100, kind of doing the same strategy. Like, was that the catalyst and the market signal to really do this strategy on a very wide basis among a bunch of different companies?
Yeah, I think that's probably in large part correct. If that's the way the ordinary average investor behaves, why wouldn't it be the way that companies behave? I think there's often a misperception of institutional investment being much more sophisticated than uh, retail investment. In some cases it's true, but I also think they can be just as prone to trends, just the way the ordinary average person can, because they're still people. And if you just think about, okay, if another company was going to copy the strategy, they probably weren't going to do it in 2022. 2022, the narrative was Saylor's going to get liquidated, which didn't happen, was really never realistically going to happen. 2023 also wasn't a particularly the great year. And, it was really when Bitcoin came back around again. It wasn't suddenly that strategy by itself did well. It was, Bitcoin hit 100K for the first time. Bitcoin was doing well. The strategies amplified Bitcoin. So, it had its big move. And really, it was I think really answered the question, can this business model even survive a 4-year Bitcoin cycle? And it did. It survived it very well, and it did very well. Even at the prices we've seen today, strategy is still significantly higher than it was. It's still 10x off the bear market bottom. It's still significantly higher than it was when they started the strategy, 4 or 5 years ago. So, I think the model has proved itself. Despite market softness right now, as long as Bitcoin continues to do well, so will these companies. And even though the broader market for Bitcoin treasuries is a little bit soft right now, if you've got 1,000 Bitcoin on your balance sheet or 5,000 Bitcoin on your balance sheet, you're not a company that's really in that bad of shape. Even if you're not accumulating Bitcoin at current levels, you've got a very strong balance sheet. And there's going to be ways to monetize that balance sheet. And when the market gets stronger, even if that's not within the next 2 weeks, if that's within the next few months or the next few years, these companies that have followed suit with strategy are in a very strong position to execute, in my opinion, over the next 10 to 20 years and deliver a lot of shareholder value.
Yeah, I mean, to me, it's funny that people will look at, a lot of these companies, but strategy in particular, and be like, oh, strategy's failed, like the model doesn't work. And then, right the week before that, they announced their USD reserve. They raised like, 1.5 billion or something along those lines of dollars. And like you mentioned, before they started the strategy, it was like a $500 million company. Like in 1 week, they raised 1.5 billion. After the stock had gone down significantly from the 2024 blow off top that it had. So it's just crazy how I feel like adoption and the growth in the Bitcoin treasury space has like grown significantly, but the short-term volatility just is so extreme that it kind of warps a lot of people's minds. I'm not sure if you like agree with that or if you have a different perspective.
Yeah, I think especially one of the things to always keep in mind is when you've got a technology that's growing, exponentially or by a power law or however you prefer to think about it, when it's growing very rapidly, when you have these periods of euphoria, you always have to keep in mind that the majority of people in the market at that point in time are people who just entered. And because that's what it means to have the kind of rapid growth is at any given time, the majority of participants are new participants. And they are not used to the volatility. And it's like that Mike Tyson saying, everybody's got a plan until you get punched in the face. Everybody thinks they can handle the volatility until they get punched in the face by the volatility. And because people, I think, in the back of their minds think, well, yeah, but this time it's really going up only forever, right? but it's not. But that's part of the game. And volatility does cut both ways. We've seen strategy go down to the depths and come back, just like we've seen Bitcoin do multiple times. And I don't see any reason why we wouldn't continue growing. I think the Bitcoin, despite a relatively softer price action, I think has never really looked stronger in terms of institutional adoption, of clearance of regulatory obstacles, and really having the stage set for a much wider adoption.
Yeah, I agree. It's Bitcoin adoption, like in the grand scheme of things, is happening really fast, in my opinion. And there's so many positive developments that have occurred. And look at the historical price performance of Bitcoin. Yes, if you look at this year, it's not great, but if you look at almost any other time frame, it's pretty great. So it's probably just a matter of time until that progress continues. I do want to ask you about, when we recorded last year, we were analyzing, or you were analyzing in particular, MicroStrategy's convertible notes. Obviously, now they've pivoted towards preferred equity, perpetual preferred equity. What are your thoughts on that pivot overall?
I think it solves a number of things that people talk a lot about how hard the convertible bonds can be on the common stock just because of the way the pricing cycles work out. But I think there's more factors to it than that. That one, those convertible notes have a definite maturity, whereas the preferred stocks do not. So you eliminate that refinance risk. You eliminate that maturity risk. You do pick up a forever dividend, but there are ways to fund that. And something else that doesn't get talked about as much is that with Bitcoin volatility down, I think the path to securing more convertible notes isn't as strong as it used to be. If the way those are typically priced out is, say if strategy would typically issue them at times of high volatility. If they issue them when the stock is at 120 vol and they discount that vol by 60%, and they give it to convertible bond arbitrage shop for a 50% premium, that is very creative. But volatility these days has been, say, between 50 and 70, and if you give a big discount on that vol, then all of a sudden your convertible bond is only bringing in maybe a 20 to 30% premium, which is not as attractive. So there's both the pricing of the convertible bonds is heavily dependent on current market conditions. The ability for even if you were willing to take worse prices on them, there's the desirability of the note, the ability to sell them at all, is heavily dependent on market conditions. And the preferred stock strategy really upends a lot of that. The buyers, they don't care what the current volatility of Bitcoin is. They just care about getting their 10% dividend. You do see a little bit of volatility in the principal that fluctuates a little bit with Bitcoin, but for the most part, the buyers really, what they're there for is just the dividends. They're not gamma trading the volatility. They're not doing the types of things that convertible bond arbitrage desks do. And you're not dependent on a big spike in the Bitcoin price or the volatility to suddenly have a window to issue them. You can pretty much issue them all the time, and you see strategy, pretty consistently issuing them every week. Some weeks not, but for the most part, it's something that can just continue issuing into the market because there's always a demand for fixed income products. And other aspect of that, people always knock strategy for not buying the dip, even though from a practical consideration, it was more advantageous to buy the tops with convertible bonds, or when you're just doing ATM on the common shares, because that's when your MNF tend to be the highest. I think a lot of people never really understood that. But with the preferred shares, that's no longer the case. The optimal time to issue them is whenever the pricing is most favorable, and that can be the dips. The trade-off is the interest rates might be a little bit higher, but if you can, let's say you're looking to pay a 10% dividend and you need to pay an 11% dividend when the price drops 15% or 20%, well, that's an even better deal. Of course, there's some fudge factor with the numbers there, but it's a tool that works in more advantageous market conditions. Also in bear markets, if you have not fully leveraged up in bull markets, then it's also a tool that can be used in bear markets, which convertible bonds really can't be. I've seen a lot of companies talking about how, when they're trading below 1x MNAV, they're trading at a 0.8 or a 0.9. Well, we'll just issue a convertible bond with a premium to get that back over 1x. Well, no, you're not, because the bonds just won't sell under those conditions. But you can sell the preferred stocks under those conditions. And so I think it really does change the game in a lot of ways for companies that are able to achieve a sufficient size that they can issue them and also get enough liquidity in them that they can continue issuing more of them into the market.
Yeah, you made some really great points there. And I think another one is like, Michael Saylor, I guess maybe even as of 2024, they were like the largest player in the entire convertible bond market. And so I think like at a certain point, they they kind of hit the TAM of that specific market to some extent, even though it's because looking back at these convertible notes, like arguably it's a somewhat complex, like unique, like finance product, but it's arguably a pretty interesting product, right? And I guess that's why he started with his first preferred equity. I think it was STRK. If I remember correctly, it was STRK, or that was one of the first ones where it
Yeah, it
was
was
like, hey,
the
like,
convertible.
yeah, here is yield with upside potential, which is like, if you compare that to other asset classes, that's kind of similar to real estate. That's kind of similar to equities. And then like the convertible notes themselves, it was like, here you can get upside exposure to Bitcoin, but pretty significant downside exposure because all of the convertible notes, there's a MicroStrategy had a huge balance sheet and little liabilities outstanding. So arguably it's a good product. It's just, there were some problems, obvious problems with it, but it seems like this new digital credit space, which I kind of want you to dive a little bit further into, seems to be like a targeting a much larger total addressable market, right? Like the fixed income space is like a $300 trillion market. Everyone wants yield at this point, especially in like a relatively yield starved world. How do you see like this digital credit space evolving, over the coming years?
Sure, I think it's a good point about the convertible bond market really having been tapped out. I spoke to several of the convertible bond desks earlier this year, and they're like, "Yeah, we're kind of crying uncle over here. We really can't take much more paper." So I think even if they had wanted to issue another, say, 100, 10, 20, 30 billion dollars of convertible bonds, the demand wouldn't have been there. But yeah, so digital credit, um, I think there are some challenges. Like most of the fixed income market is not preferred shares; it is just bonds. It's regular bonds. So there is, I think, there's a challenge of changing consumer behavior, of changing investor behavior, to get them to buy into this type of a product, which is a different product than they're used to seeing. I mean, strategy didn't invent preferred shares, but it tends to, the ones that previously existed tended not to have large market shares of the fixed income market. But the market segment of people that this is targeting is very different. The convertible bond is a very niche product, really only sold to arbitrage desks. There were some insurance company buyers and people who were just long the bonds, but that was just a tiny sliver of the issuance. And the TAM for people who just want plain yield on their cash holdings that they'd otherwise be putting into bonds is much larger. And so I think over, say, the coming decades here, I think this is a product that probably has a 10 to 20 year shelf life, in my opinion. Even a lot of people talk about, okay, it's a forever dividend obligation. My opinion is it probably towards, of course, you don't want to sell it this way. You don't want to say, yeah, we're going to buy it back in 10 years. That's not the way you're going to sell it. But I think that probably, as the delta between the rate of appreciation of Bitcoin interest rates compresses, that it's going to be less attractive to issue these. So, how long until that happens? I think probably 10 to 20 years. There's probably a 10 to 20 year run here. After that, maybe they think about retiring them. So I think this is a product that really captures this window where Bitcoin is capitalizing. So there is this window in time where you can arbitrage capital markets to acquire Bitcoin and basically leverage cheap interest rates to acquire Bitcoin. It's probably a 10 to 20 year window, and I think that probably as more people get comfortable with this idea of holding an asset that's an interest bearing asset that's tied to Bitcoin, probably interest rates could come down. Right now they're paying 10%. And so if strategy can get investment grade ratings on their products, if interest rates can come down to say 5 to 6% to be more in line with the typical corporate rates, that extends the timeline for the accretiveness of these products even further. So I see over the coming years, I see wider adoption, I see better credit ratings, lower rates, and all kind of feeding back on each other to create this Bitcoin accumulation engine that just keeps ramping. and probably will turn strategy into one of the largest, if not the largest, companies over the next 10 to 20 years. And of course, there are other companies doing it. There's Strive, and there's MetaPlanet, and possibly more to come. But I think any company that is able to successfully tap into the fixed income market will find that it does quite well over the next 10 to 20 years.
Yeah, you brought up the idea of like kind of the end game of these perpetual preferred products, and you offered, I guess, the potential perspective that at some point it's certainly possible that Bitcoin's CAGR becomes less than the dividend that was promised. And this might be an interesting topic just to kind of touch on a little bit, because I have asked like kind of Saylor this before, and he believes that Bitcoin will have this is what he said, like a terminal growth rate of around 20% or something, maybe like 2x the S&P 500. Now, I guess he believes that if he said it, but it's also like I think you could argue this multiple different ways. Like, one is like, okay, if you believe that Bitcoin is actually, and I want to kind of just get your thoughts on this too, but first, like if you believe Bitcoin is a better form of money, well, arguably this is kind of like the entire idea of a speculative attack, to where eventually the harder money gets stronger and stronger, and it just kind of like kills the weaker money. And so maybe that's a potential vision that he could have, to where it's like, okay, well, if you're concerned that the Bitcoin CAGR is going to go less than the dividend rate on the preferred equities that you promised, well, what if we see hyper Bitcoinization? Then I guess it doesn't matter how many dollars you owe if they're not worth really anything. And then, or go ahead.
Sure.
I have some more thoughts, but go ahead.
Oh yeah, why don't you just go ahead and finish, then I'll respond.
Okay. The only other thing, and then maybe you can make the other argument that like entering the world of AI and extreme, potentially incredibly rapid technology deflation, you could possibly make the argument that like global economic growth is going to explode, and the prices of consumer goods might go down, significantly, at least measured in sound money. And therefore, to keep, prices going up in dollar terms, the money printer has to churn even more aggressively than it has in the past, perhaps like incredibly aggressively. And maybe that's how Bitcoin, can keep going up at a rate greater than 10% per year. But I'm curious, like, how do you see this playing out?
Yeah, there's a few different avenues there. I think to tackle, I think the first easiest case, what if Bitcoin just becomes money? Well, you can't borrow in Bitcoin and pay interest on it to take advantage of Bitcoin to pay back that loan later with the Bitcoin. That doesn't work.
Yeah.
So there, if the end case is Bitcoin just becomes money and replaces fiat, then this type of business model is just something that goes away, because the whole thing is an arbitrage on fiat.
Yep.
And which I think highlights the point that how you see the end game playing out, I think it really depends what you see as the end game for fiat. Does fiat still exist in 20, 30, 40 years? I think probably the average person on the street today, if you ask them this question, would say, well, yeah, I think it will. Bitcoiners might answer differently, but things could change very rapidly if you get that kind of gradually then suddenly moment. The other scenarios, I think, if we do get into this hyperinflationary phase of fiat, then I think that is probably another scenario where, okay, if you get into this like exponential fiat is depreciating at 20, 30% per year, that's probably more like, not this keeps happening forever, but this is end stage fiat. This is fiat exponentially depreciating until the system just breaks. I would say that's a trend line towards end of fiat, just Bitcoin standard. And if somehow fiat does continue to linger on longer, and I think there's two different ways to look at appreciation of Bitcoin. I think one is in nominal terms, one is in dollar terms, and the other is in real terms. And I think if you're thinking about it in real terms, then it's difficult for me to see Bitcoin in its final stages appreciating faster than the overall growth rate of the economy. Because why would it? How could it? Maybe there are some answers to that, but I think if the overall economy in sort of real terms is growing at 5% per year, and Bitcoin is the universal standard of money, it's hard for me to see how it could appreciate faster than 5% per year, because everything divided by 21 million. That numerator is only growing at a certain rate. But if we have an AI boom that suddenly the economy is growing at 20% per year, well then yeah, and if Bitcoin is growing at the rate of the economy, then okay, yeah, you're going to get your 20% per growth. But then how sustainable is that? It's tough to maintain 20% per year growth. So in my opinion, I do see the terminal stage is just mirroring the growth rate of the economy. I think one way or another, even if it doesn't replace fiat, it probably hits some kind of saturation point where that's roughly what it does. But I think the key thing to think about is, people always say arbitrage is closed. Is what does that time frame look like? And in my opinion, it's at least 10 to 20 years, possibly longer. And because if you're looking at Bitcoin now, it's not growing at the same rate as it was 10 years ago. It's still growing at a tremendous rate, but I think diminishing returns are a real thing. But again, it's a question of timeline. And if the timeline is 10 to 20 years or longer, that is the actionable, investable time horizon for most people. So that's kind of how I see those points.
Yeah, it's fascinating to think about what actually might happen, but at the end of the day, it is likely pretty far away, and with AI advancing so fast, especially like what it might be 10, 20 years from now, it's hard to even try to predict the future at that point. But maybe on like a more shorter, more relevant time frame for most people, like looking back at this year, Bitcoin's been flat to down, I guess. But this has kind of been the year that digital credit was created. Like the first perpetual preferred equity existed this year, or by strategy at least. Where do you see this playing out during the next actual like Bitcoin bull market? Like if Bitcoin can actually go up in its $1 price, whether that's next year, the following year, or whenever, how do you see that playing out with this digital credit product?
I think that a lot of the people who are skeptical about it now will suddenly become fans of it if we do see Bitcoin actually entering a true bull market. Because you could argue that the preferreds issued so far this year have been just net dilutive rather than accretive to common shareholder value. Because one, they're issued at a discount. They were all of them were issued at a 90 to 80% of share value, 10 to 20% discount. And Bitcoin price has trended down over the past few months. So they're issued at a discount, and the Bitcoin that was bought with them has also decreased in value. So, and a lot of people say, okay, the common owns the Bitcoin, and we're just going to ignore the preferreds. And I don't really think that's the right way to look at it. If you enter a leverage position, if you borrow $100 and then you buy something with $100, net, you are not up. Your net value of that position has not increased by $100. Then it changes zero. And I think that's probably a better way of thinking about the preferreds, is that it's value that increases over time, and it's not value that's immediately booked to the bottom line. And so I think we just need some time for the Bitcoin price to go up for the value of these preferreds to be realized to the common shareholder. If Bitcoin doubles from here, then suddenly the picture looks a lot different. Suddenly all this preferred issuance is massively in the money. So I think once we start seeing some of that happen and we see the value really being realized for the common shareholders, that's when I think opinion around these starts to turn pretty significantly.
I agree with the sense that if Bitcoin starts running, then yeah, obviously the strategy will appear and be working as Saylor would expect it to be working. With that perspective though that you had there, like, do you have an issue with like the BTC Yield metric that Saylor has created, like increasing Bitcoin per share by issuing preferred equity and like immediately showing that, hey, our Bitcoin per share went up today? Do you think that like that's not a good KPI, or what are your thoughts there?
I have kind of mixed feelings about some of the metrics being used, because I the way I conceive it in the, if you're just taking on leverage, then it wouldn't be the case that you immediately book the full value of that position to your, like I was explaining earlier, if you borrow $100 and you buy something with it, your net worth isn't increased by $100 immediately. The way, MNAV is typically calculated, that debt is factored in, typically into the numerator. Despite putting Bitcoin NAV, net asset value, in the denominator, it's actually not net; it's gross. it's mislabeled. I think probably a way to calculate the metrics that would make the numbers move in a way that's kind of more expected by people is if you actually did have Bitcoin net asset value in the denominator. If you took the debt out of the Bitcoin value, you had the market cap in the numerator. I think that probably would move in a way that looks more like a typical leverage position. So the way it is now, where just kind of everything all diluted is baked into the number all at once, I think gives the impression of the full value of the Bitcoin being booked to the common right away. And I think it tends to make the numbers just not move quite right over time. So so mixed feelings about some of the metrics. I think it could be done differently. But in the same token, there is still value in looking at fully diluted numbers, especially if you're trying to figure out at the end of this operation, is Bitcoin per share up, down, or not? Then you really do want to be looking at those fully diluted numbers. I think there is still a place and a value for doing it that way. Of course, with the preferred shares, it's not quite as straightforward. If for the convertible bonds, it made a lot more sense because you knew exactly at the end of the day how much dilution there was going to be. Because the bonds convert at a set rate, and that's just what it is. For the preferred shares, it's you don't know exactly how much dilution it's going to be. You can run some models where you make some assumptions about growth rates and the price of the stock year over year. But at the end of the day, you don't really know until it actually happens. So and even the way people calculate MNAV now, there's several different ways of calculating it. You can put enterprise value in the numerator. You can put diluted share value, and each one of these has slightly different implications for where you are in relation to the price of the debt. And it's actually a lot of nuance that I don't know how much valuable it is to go in now, but there's pros and cons to all these different ways of measuring it. And I think just the take-home message that I would like to deliver on this point is that I think it's better to think of the value of the preferreds as something that essentially, day one of issuance starts at zero and increases over time, rather than the full value being realized on day one and then having that value ground down over time by paying dividends. I think it's the way it's often thought about needs to be inverted.
Yeah, that's a really interesting perspective and a lot of great points. And I feel like what you mentioned near the end was great. I was like, there's a lot of pros and cons with all of these metrics. I mean, it's there's different, like you said, there's different ways to measure MNAV. BTC Yield can be useful, but like if you're looking at something through a certain perspective, then you might be like, this doesn't even make sense. So it's interesting to think about. I would, like, me personally, thinking about BTC Yield, I do like it as a metric. I definitely like see your point of like, okay, well, if you borrow money, which ignoring the fact that it's preferred, but like you borrow money, you buy $100 asset, you borrowed $100, like, well, your net position should be zero at that point. It's not like you just randomly got a free $100. But I would say, like, if you're, to make like the counter argument, I guess, would be if you are like a triple maxi is like Saylor would say, like, and you believe Bitcoin, for the foreseeable future is going to be growing at a 50% CAGR for the next 10 years, something along those lines, then arguably, I think, like, or this was probably his argument, like, arguably you could book it all to the balance sheet immediately, because next year, after Bitcoin's gone up 50% and your dividend was only 10%, then that enables you to issue additional preferred equity to continue growing your Bitcoin per share, as long as you think that Bitcoin's CAGR is going to be greater than your dividend outlay, so you can like keep growing the balance sheet. But I see your point of like, okay, well, like, you don't know even in Bitcoin terms, you don't necessarily know how much Bitcoin you're going to be spending to make that dividend payment, as long as you have this perpetual preferred equity on this book. And like we talked about earlier, I guess, like, it doesn't make any sense to even do this model if Bitcoin's CAGR drops below the dividend rate that you have to pay. Like, obviously that would not even be, the whole model doesn't even work at that point. So you kind of have to believe in Bitcoin for any of this to really work to begin with.
Yeah, the other point I would pick up on there, with regard to the Bitcoin yield figure specifically, I think made a lot more sense when convertible bond issuance was common, because you could really measure it very precisely how accretive it would be, assuming the bond's converted. And I think, speaking to the value of the metric in the preferred age, even though you don't really know exactly how much net Bitcoin is going to be realized by the common shareholder, for that figure specifically, what is the alternative for calculating that? I don't think there really is a good one, because you have to make up all kinds of crazy assumptions. Maybe not crazy, maybe completely rational, but at any rate, assumptions. You have to make a ton of assumptions about what the future is going to look like. So I think for the Bitcoin yield figure specifically, I think it's still probably one of the best figures you can use for what it measures, because there really aren't good alternatives for that specifically. I think other figures like MNAV, I think you could do a little better with. But for Bitcoin yield specifically, there just really isn't a better way to measure that I can think of, because you just have to make too many assumptions.
I agree. That's a great point. I want to keep talking about digital credit, because I feel like that's, there's a hot topic this year. It's probably going to be a hot topic for 2026 as well. Saylor has kind of come out with this idea recently of digital money, which is basically, I guess, like a dollar like IOU type product that's backed by Bitcoin. So, like, for example, a bank holds assets on its balance sheet, liabilities on its balance sheet. Liabilities are customer deposits, dollars in your bank account. Assets are mortgages, T-bills, but could also be digital credit. What do you think about this concept of digital money?
Well, I mean, I would have said that Bitcoin is digital money, but but I think in the spirit of the question, I think we are going to see a lot more built on top of products like Stretch. Stretch specifically, not all the preferreds, but specifically Stretch, because it's geared towards having a stable principal and a variable yield, and we've already seen it. We've seen just in the past week, I think Project Saturn announced their launch, and basically, the idea of that company is, we're going to build Tether, but instead of backing it with treasuries, we're going to back it with Stretch. And I know for a fact there are other teams building on top of Stretch, looking to build other combinations of yield products. I myself am consulting with a hedge fund that is building yield generation strategies, leveraging Stretch and other derivatives in the strategy ecosystem. So, I can only think that if more Bitcoin native people are thinking about this, then certainly the banks are also going to be thinking about this. And I really expect an explosion of derivatives and other types of products built on top of the Stretch like preferred shares that come out.
Yeah, I mean, Stretch is really interesting because, I think when Saylor first created it, he hoped it would have been like a zero vol asset, like perfectly stable. And then, it seemed like it was going to trade like that for a little bit. And then I think he's kind of come to the realization that, all right, like, this is never going to be a zero vol asset. Therefore, there has to be another layer, and kind of like what we talked, Saturn or digital money or stable coins or whatever it would technically be called. Like, that's how it's going to play out. Are you surprised that, like, that's the route that he's going to, like, try to get more greater adoption for his digital credit products? Or did you think, like, there's a better way for him to try to effectively sell these, I guess?
Well, I think it's very much a playbook that's being developed, as the airplane is in motion, so to speak. You kind of get two different camps about that. You think that there's people that think that strategy has everything planned out to the step for the next 10 years, and and the people like, he's just making it up on the fly. Well, I mean, this is a brand new business strategy. they, you launch something, you have your best ideas for how it's going to work, and then it actually goes out, interacts with the market, and things happen that you don't expect. That's the reality of doing any business ever. So, I like the fact that they are thinking about how to innovate on it. My thought when Stretch first launched was that this is the product that really there was going to be demand for. That if they could actually make it work, this is what there was going to be the most demand for. Because my mind, how the roadmap worked out was, first they did the convertible because that was closest to what they had been doing. They had the most familiarity with that. So okay, we launched the convertible, and then you look out and you go, okay, what's the fixed income market? What's the biggest TAM? Okay, well that's investment grade debt. So we'll put out Strife, and that mirrors the largest fixed income segment. What do you do after that? Okay, well we've got our investment grade like product. So now let's put out jump bond like product. Put that out. There's our second biggest TAM. And then I think the way it turned out, if you were monitoring the conversations, say late spring to early summer, what most people were trying to do is put their, in my opinion, what most people were trying to do was trying to use these as short-term cash savings vehicles, which they were really not designed that well for. And so when Stretch came out, it seemed like, okay, yes, this is what the market is already trying to do with the products that are on the market. So this is going to be a much better fit. So, but then the challenge with that is, how do you maintain that peg? If you're trying to peg it at $100, how do you maintain that peg? Well, if you're trying to do it with interest rates that you can only adjust once per month, you don't really have that much flexibility. You either have to run the interest rate so hot that you can always blast that over the mark, or you have to do something else where you can adjust that rate more frequently, or you have to find a whole lot more demand for it. So there's only so many things you can do to maintain a peg. So I think having a system that a derivatives ecosystem built up around it that adds demand to it, that arbitrages some of that volatility away without strategy having to do it themselves through plunge protection or whatever else you might do. I think that's will be net beneficial for maintaining the peg, keeping the price stable, and making it more like that short-term cash savings vehicle that many people want to have.
Yeah. This is another topic that you might disagree on, but I'm curious to see what you think. And you pointed out earlier that there's been, this entire strategy has evolved pretty significantly over the last year and a half since we last spoke about it. But I think I would still personally make the argument that the core strategy of borrowing dollars or getting access to dollars and buying more Bitcoin and creating this either leveraged Bitcoin position or now amplified Bitcoin position, the core strategy in my mind, is still the same. It's how can you most efficiently with the lowest amount of risk get amplified Bitcoin? Obviously the way he's done it has evolved significantly, but the same, if anything, it's just in my mind, it's mostly just improved. I'm curious, do you agree with that, or do you see it differently? Because I think a lot of people feel like he's completely changed everything, and he's doing different strategies that weren't really congruent with previous strategies. How do you see it?
Yeah, I think that is actually exactly right. I mean, the core premise is, can you borrow dollars cheaper than the rate of appreciation of Bitcoin? At the end of the day, it really all comes down to that. And I think that a lot of the people who are dissatisfied with the preferred share strategy probably really haven't sat down and done an apples to apples comparison. It wouldn't be apples to apples, but really haven't sat down and really done a closed comparison, in terms of numbers with convertible bonds. I just did a basic worksheet for myself because I was trying to see, okay, if you assume that the preferreds are only ever paid dividends by selling the ATM, none of it comes from income, it's all just share sales, and you project this out over 10 to 20 years, what does the net issuance look like for a convertible bond versus a preferred share? And when you do that, if the 30% CAGR assumptions are correct, then you wind up issuing half or less the amount of shares to pay down the preferred share dividends than you do converting that convertible bond. It's actually far less dilutive to do this, even though it looks like you get these massive forever dividend obligations. And the other thought I had was, okay, let's say they do decide they want to retire these someday, and let's say that day is 10 to 20 years in the future. Well, if Bitcoin has appreciated at 30% per year over that time, the principal has almost evaporated versus the Bitcoin value that it went into purchasing. So it doesn't actually add that much to the dilution to go ahead and just retire those at the end of the period. Of course, the ones that you issued closer to the age of retirement are going to be a little bit more dilutive. But yeah, I think that the core principle is the same, but I think the messaging is very different because the target buyers are very different. When you're selling to a convertible bond arbitrage desk, they are buying the volatility in a very real way because they're making their money by gamma trading the volatility. That's what they do. They're trading that stock like crazy, and that's how they make their money. When you are selling a 10% preferred share to a retiree, he is not trading that at all, does not want to trade that, has no interest in trading that, just wants to park it and let cash build on it. So the marketing messaging you're going to go to market with are very different. But at the end of the day, the aspect of borrowing cheap dollars to buy Bitcoin that appreciates and capturing that spread is what is in common between the strategies. And who knows, maybe somebody else will think of a better way to do it.
Yeah. I mean, I think a lot of companies are probably trying to think of better ways to do it, and I know Saylor himself is trying to think of better ways to do it and to continue improving. So it's great points. I'm curious if you have a perspective on this. The last maybe I guess month and a half, 2 months or so, Bitcoin hasn't performed super well at all, whereas like pretty much every other asset class has done decently well or massively outperformed Bitcoin. And some people have pointed out that there was that massive liquidation event in the both Bitcoin and crypto world on I believe October 10th of this year. And like there's rumors that market makers were washed out, or weird things may have happened that day, because literally a lot of crypto coins actually went to zero that day for a brief period, which is quite crazy. Like, what do you make of the last month and a half, 2 months for price action? Do you have any is there any credibility in your mind behind like a market maker went down significantly and that's kind of why Bitcoin hasn't performed like people thought it would?
I am a little bit skeptical that the 10-10 event is really what's driving everything, because Bitcoin really didn't have a massive year prior to that. That I think empirically what we've seen, and, people have covered this in very different ways, but we've seen a lot of selling by OGs, and the whole Bitcoin had its public IPO moment. I think is a narrative that I subscribe to, at least in part.
Yeah.
Of course, I think it's a description of what trading behavior has happened. It doesn't necessarily say why it happened. We know empirically that there's been a lot of selling by some of these older wallets. We don't necessarily know why the cohorts look so different versus newer buyers of the the ETFs, which seem to be a bit stickier. But we can say that this difference did exist, and that was something that was happening well before the 10-10 event, and I think it is still happening. So it just doesn't stack up in my mind that event is really what is driving all the price action today. And certainly I can't say I think it helped any. I mean, certainly it was a drag on the space, but I just don't see that as really being the defining factor, because so much of the trends of what we've been seeing were already in place before then. And I think that we've seen even prior to that. If you look, strategy early part of the year, there's a lot of conversation around people are just selling the volatility so hard. And we've seen that reflected in the native Bitcoin market as well. There's just enormous interest in selling the upside volatility, much more so than there has been in buying long volatility, being long call options. The covered call market has gone crazy. We've seen covered call ETFs. There's just been enormous selling of the upside, and for whatever reason, whether that's because OGs have after 15 years finally have the liquidity to realize some of their profits, and eventually they run out. Hopefully they run out. For whatever reason, that has been the market structure for most of the year, and I think really those sellers need to be exhausted. The new buyers need to overwhelm the OG selling in order for us to flip around.
Yeah, I agree, and I think like the OG selling is a, from what I've heard as well, like that's pretty accurate narrative. And I feel like on the other side of the OG selling, like this is where Bitcoin and the Bitcoin community and Bitcoin price action is going to be in a better place. It's like, you compare Bitcoin to the fiat system. Fiat naturally centralizes wealth over time. Bitcoin is obviously, very clearly doing the exact opposite, where it's like the OG holders that have hundreds or thousands of coins, very obviously, distributing coins to treasury companies, ETFs, individual holders that just stack and hold their own keys as well. So I feel like it is a good thing. And then on the 10-10 point, I agree. Like after watching the Bitcoin price over many years, I always felt like a lot of journalists or even just like Twitter engagement baiters, effectively, like everyone just kind of like captures to a certain narrative and tries to explain like, oh, well, this is why the price is behaving why it is because of this specific news article that came out or this headline. And it's like maybe that played a role, but like this is also just a hyper volatile asset. Like, I mean, I guess if you look at Bitcoin's volatility over the last, pretty much, for all of Bitcoin's history, it's like Bitcoin's volatility is still pretty low, like extremely low right now. And maybe this is just like a normal, fairly random movement. And eventually Bitcoin's just going to go higher, just like it has done countless times.
Yeah, for sure. There's all kinds of explanations as to why price moved this or that way. I've seen this in other industries. Before I was heavily involved in Bitcoin and worked on online advertising, and there's an enormous amount of variance in performance every day. And we get calls from clients saying, what happened this day? It's like, well, nothing, ordinary variance.
Yeah, exactly.
90% of the time that was the answer. So, and I think there's a certain amount of that in Bitcoin. It's really difficult to disentangle the factors at play and really say, yeah, this was the cause of what happened. I would argue that a lot of people really don't even think correctly about the way the last cycle ended. In 2021, people like to point to FTX and to Celsius and these types of folks, but I think that's really kind of most likely inverting causality. Probably what I think happened there was that the major thing that changed was the Fed changed course. And it wasn't that these companies blew up and then took down, Bitcoin and the crypto markets with them. It was that liquidity changed. And as I think I don't remember if it's Buffett or Munger, but when the tide goes out, you see who's been swimming naked. And so I think when liquidity tide goes out and people go bust, it's not the people going bust that causes the market crash. It's the liquidity going out that reveals who was in a very bad position to start with. And that, in my opinion, is probably more of a driving factor.
I completely agree there. Another point, and this is kind of, it's kind of ironic that I'm bringing this up, but I still think it relates to kind of what we said earlier, where yes, Saylor's core strategy and many of these Bitcoin treasury companies, the core strategy is create an amplified Bitcoin position in the most efficient way possible. However, over the last few weeks, Saylor did create a USD reserve. So, one, what are your thoughts on the USD reserve? Personally, I still think in the long run, it helps create the amplified Bitcoin position. I think that's what Saylor would argue as well. But it is kind of interesting how, okay, well, why is he buying dollars if he's trying to short dollars. What are your thoughts on the USD reserve for strategy?
Well, I think it's a good thing, and that's I know that's not an uncontroversial position, but I think when Strive launched their preferreds and said, yeah, we're gonna hold back years worth of dividends, that was very well received. And when I saw how well received that was, I thought it was probably just a matter of time before Strategy decided to copy that. They did, and uh, and I think it will be beneficial in several different ways. One is that okay, you can be sure that they've got, I think it's 31 months now of dividend coverage. So if you plan on getting paid dividends the next 31 months, you can be certain that the money is there. There's that just from the investor buyer perspective. But also, if you're a credit ratings agency, one of the things that specifically was flagged by S&P Global was their dollar liquidity. That's not so much of a concern anymore. So I think the more of these things that they can do to both assuage investors and credit ratings agencies, and not just retail, but the institutional investors who are potentially going to be buying and holding these, that's that's right. Green dots beget orange dots, as Saylor put it. The more confidence there is around these products, the higher the ratings they will get. The lower the rates will go, the more they'll be able to sell, and the more accretive it will be to the common shareholder.
I agree with that as well. I think that was a great point. I think it was you that made a tweet kind of today. It was like, okay, well, now with the USD reserve to where it is today, it's like it's incredibly difficult, if not impossible, to argue that strategy is doomed to fail, in the next 24 months because they are holding the cash. I guess like at this point, for strategy to fail, you need both Bitcoin to completely fail, and you need the US banking system to completely fail. And then maybe strategy, has less than 24 months remaining. And like that's that's pretty far out there. If the US banking system fails, I think we have bigger problems on our hands. So I feel like they've created a fairly like robust amplified Bitcoin position. And I think a lot of other companies are going to copy. One final question, I guess, that also just came to mind is, do you think that there are too many Bitcoin treasury companies? Do you think there's a very clear limit of how many there can be? How do you think about this? Can too many companies buy Bitcoin?
Well, my thoughts have changed about this quite a bit in the past few months. Can too many companies buy Bitcoin? I'd say categorically no. Every company needs Bitcoin on the balance sheet, but not every company needs to be a Bitcoin treasury company. I do think there can be too many Bitcoin treasury companies, and I think that most likely, many of the companies that came to market in April and March, that March, April, May timeframe, will never be heard from again. They will never raise another dollar from capital markets to buy Bitcoin. And even many of the ones that did, I think we'll probably see some, M&A, some, various forms of, consolidation in the marketplace. And I think that, looking toward the future of Bitcoin treasury companies, companies that are not just, funneling their operational profits into Bitcoin, but really trying to be active in capital markets. I used to think that we would see, some flavor of that in every distinct capital market, every jurisdiction. And I still kind of do think we'll see some level of capital markets activity in every jurisdiction, but I don't think we'll just see like a major company, let's say, a $10 billion company. I don't think every jurisdiction could support, say, like a $10 billion company, at least kind of, speaking at somewhat close to current valuations. I think probably, maybe just like the top 10 capital markets in the world could potentially support that. If your local jurisdiction has, a total market cap of, say, $1 trillion or more, potentially you could have, a robust Bitcoin treasury company in that market. Once you start getting smaller than that, it's probably much more difficult. I think, in the US, strategy has already won the battles for number two. I think, Europe is probably still open for a significant player to become the number one there. I mean, there are a lot of companies that are roughly in the same spot in Europe. And I think Japan, Metaplanet is in a good spot in Japan. China has proven regulatorily difficult. If some of the red tape can ever be cut through there, potentially another major one could emerge in China, maybe India. Probably outside of some of these large countries, these large economic regions, it's going to be difficult, I think, for a really globally interesting Bitcoin treasury company to emerge. Even though you could see maybe regional players that are a magnitude or order of magnitude smaller, but still like pretty sizable companies within their own market. So broadly, that's kind of how I see the space playing out. But within that, I think the number of companies that are digital credit issuers, and by digital credit, I'm just going to specifically say, I think I mean preferred share issuers by that. I don't think that. I think even fewer companies will actually become preferred share issuers. Probably, I'm not really confident we'll even see more players in the U.S. market. Maybe 21 will issue preferred shares. Maybe there will be another large company in the U.S. that in the strategy vein that tries to do it. But I'm not expecting like 20, 30, 40 of these companies in the U.S. or in each market or even globally. I think there'll be maybe one or two in Europe. There could be one in Japan, and I don't think the list really gets much longer than that. I think it's a very niche strategy that's a winner take most, and so the capital markets that actually can support the liquidity and the market size needed for one of these companies to really be successful, there just aren't many of them. And so there'll be one dominant player in the markets that can support it, maybe a second or a third smaller player, and I think that's really going to be it. But that said, that's not the only capital raising strategy in town. There's still going to be a lot of companies that can raise money through convertible bonds. I think especially in the smaller markets, we'll probably see those mostly dominated by companies doing raises through convertible bonds and perhaps whatever local structures they can come up with. But overall, that's more or less how I see the shape of the market playing out.
Yeah, I think a lot of it, from my perspective, really just depends on what you think Bitcoin's going to do over the next 10, 20, 30 years and beyond. Like if it just becomes digital gold and kind of tops out there, then I think I would align with you pretty closely to where like there's only going to be a few like true digital credit issuers. If you expect like hyper Bitcoinization type, like end of dollar, at some point, like one best money wins, then I could see the argument like everyone's going to try to do this because it's just going to be kind of the end game. You're going to do it until you can't do it anymore. And then if it's like somewhere in the middle, which might be the most likely, where like it just perpetually grows at a power law or maybe a little bit faster at some point, and AI accelerates things, and that accelerates the growth rate of Bitcoin in dollar terms, then maybe it goes on for quite a while. So it's going to be fascinating to see how it plays out over the coming years. But Brian, is there any other, like, do you have any major like concerns for Bitcoin and the Bitcoin treasury space or the Bitcoin treasury space over the coming years, or just any closing thoughts in general?
Well, one other point on how many digital credit companies there will be. If we get to a point where Bitcoin becomes money and we're all at a Bitcoin standard, is everybody who issues a bond that pays money, meaning pays Bitcoin, or are they all digital credit issuers? you could argue that you get to a stage where every company is your digital credit issuer just because Bitcoin is the money. So there's another thought there on that side. But in terms of Bitcoin treasury companies over the next few years, I think the thesis is really simple. Is Bitcoin an integral part? Does it become an integral part of the future global financial system? If the answer to that is yes, then it's most likely that the rate of appreciation of Bitcoin will be significantly higher, or at least arbitrageably higher than interest rates for the foreseeable future. And if both those conditions are true, then Bitcoin treasury companies are going to find fertile ground for as long as those conditions do remain true. And I'm in the camp that thinks that hyper Bitcoinization is where we're going. And even if it's not full Bitcoin standard globally, I still think there's significant room for even if it's just Bitcoin matches the market cap of gold and becomes a better gold that is more widely held. There's still significant growth from here to there So, over the next few years, I think I really am not so concerned about the potential for these companies. I think, the downside would be if we have a major global downturn. If S&P drops 50% next year for whatever reason, black swan, I don't see that as being conditions where Bitcoin has an awesome year. But I would say, all else equal, I expect Bitcoin to be successful. I expect the arbitrage between interest rates and Bitcoin to be viable for, not every single year, but on average over the next 10 to 20 years.
I think that was very well said. Well, Brian, thanks so much for taking the time to do this. It's fun talking Bitcoin and Bitcoin treasury companies. Where can the audience go learn more about you and what you're doing?
Yeah, if you'd like to connect with me, I am BTC_overflow on X. That is where I'm most active, and happy to connect with anybody that wants to talk Bitcoin or Bitcoin treasury companies there.
I love it. Well, thanks again.